Yeah, go
The
ahead.
cost cutting has been smoke and mirrors. For anybody who can do math, that's clear, right? So Doge came out, they saved about 40 billion. You got a 37 trillion deficit.
Right.
What are we even talking about? This is ridiculous. It's smoke and mirrors. It gets all of the voting masses hooting and panting and going, yay, yay, we're doing this, we're doing. No, it's meaningless. It's completely meaningless. It's theater.
You're watching CapitalCosm. My name is Danny. It is June 30th, 2025, and my guests today are Chris and Brad from Capitalist Exploits, my favorite newsletter, the newsletter that got me into investing in commodities, resource stocks, etc. So, Chris, Brad, thank you so much for coming on, gents.
You're welcome, Danny.
Yep.
Good to be back, mate.
Yeah, definitely. Let's go ahead and kick things off, guys. What do you think should be front and center for investors right now as we kind of spiral towards all of this geopolitical uncertainty, uncertainty in general? Chris, I'll let you kick things off here. What should be on the radar screens for the average investor?
I think people should be stopping and breathing. Because there's a ton of information flow taking place. Much of it consequential, but to some degree noise. And what I mean by that is, so things like the conflict in the Middle East, they're consequential, obviously. But to be caught up in the noise of it, or to be caught up in things like tariffs, or to be caught up in what the Fed may or may not do with respect to the current essentially recession. There's a whole number of these things that people get concerned about and caught up in the intricacies of that and what that might mean for the markets. And our opinion, or my opinion, is that if you go back and you look at history and you look at cycles, these things are completely normal. And so we knew years ago, and we've been writing about it, that these things will take place. Not that there would be a war in say, the Middle East, but that there would be conflict, there would be war. Why? Because cyclically, that's exactly what happens. It's also what happens when countries get into too much debt. You have inflation. There's a whole lot of these things which transpire that we're watching. And what I would suggest is to sort of step back from the day-to-day noise and say, okay, well, what are all these things? Well, they're actually all, to some degree, almost predetermined. They're the consequences of the ingredients that you put into the cake, and now we're just having the cake. And so then the second step beyond that is to say, okay, if that's true, and it's clearly true from history, what benefits in these sorts of environments? What does one typically invest in? And the answers to that are actually blindingly simple. And not only are they simple, but the asset classes are now also some of the cheapest asset classes, both on a relative and an absolute basis, that they've been in decades, which is largely the portfolio that we run. It grows across multiple sectors and multiple geographies, but it's dedicated towards these undervalued asset classes. So that where those things tie in, it means that Brad and I can sit here and, we can look at, see what's going on in the war in the Middle East, or tariffs, or any of these number of things, but we can sort of just look at each other and go, I guess it's just part of what we expect, And what it means for us is there's very little that we actually have to do in terms of portfolio allocation. It might be tweaks around the edges, but broadly we're already invested for these things because it was obvious that they're coming.
It's very interesting. You mentioned these symptoms to the larger disease, let's call it, which is that we're at the apex of multiple cycles. I've heard you speak of this before. A war cycle, a fourth turning cycle, a revolutionary cycle. They all seem to have coincided simultaneously for the first time, and I don't maybe in hundreds and hundreds of years. But the key thing is that you look at the Iran-Israel conflict. That's been put on the back burner now, but it could revamp at any time. And so once this thing does revamp, you've heard things like closure of the Strait of Hormuz. There's this railway between China and Iran that transports their oil from Iran to China. There seems to be so many points of failure when it comes to the energy markets as it relates to this one war in particular. I mean, would you? Go ahead.
Then once again, if you go back and you look at these cycles, you get domestic conflict and international conflict. In any conflict, you don't have political security unless you have energy security. So yes, energy gets targeted, always. Right? So we know these things. Now, do we know where it will get targeted? No. Do we know necessarily which countries are going to be involved? No, but we can narrow it down. I mean, it's not like they're going after Burkina Faso, right? There's no. They're going after where there's oil. Iran has some of the largest oil reserves in the world. Surprise, surprise. We don't like Iran, right? Despite all the propaganda that you hear, this is what it's about. These points of failure will often be used, just like Nord Stream was a point of failure, and it was attacked as a consequence. So you prepare accordingly for that. But look, the other thing is, and Brad makes this point very well often, we don't need any of that to profit from things in the sector. Why? Because the supply and demand imbalance is typically in our favor anyway, without having so we say, cherry on the cake of a shutting of the Strait of Hormuz, or the shutting of the Bosphorus, or the Suez Canal, or the bombing of the Nord Stream pipeline, or any number of these things. They're not required in order to profit, but they are to some degree inevitable.
I'd say, to go back to what you said before, Danny, the point of failure, I'd say the big point of failure is the lack of capex over the last 10, 15 years. And when it comes to oil, is the complete reliance on US shale continuing to deliver. That's been the only real source of growth and production over the last, say, 15 or so years. We're going close to 20 years now. And so, and no one's really paying too much attention to that. Its intentions are focused at the moment, of course, in the Middle East and so on and so forth. It's a short-term thing, and you can argue about the Straits of Hormuz and whatever. Whatever. It's all very, very amusing. But as I said, the point of failure is lack of capex. Great reliance in terms of oil on the US shale so-called revolution. And all if you look at the money in the world, it's all gone into tech IT. There's nothing really gone into developing sort of old school stuff, especially in the commodity space. And that's where we find the value. It's not like we really go out and say, hey, look, we're bullish on commodities, et cetera, but we find that all these things that are out of favor and loved are a lot to do with the commodity space. And that's just a lack of capital that's gone into these industries over the last, as I said, 15 or so years. That makes us very, very bullish. Now, many of these things won't, the bullish symptoms won't show up necessarily now, but they'll show up sometime in the next 5 or so years when these supply constraints really start to kick.
And
so for us, go ahead.
And so when you're looking at oil prices where they are today at $64 or so, they did ramp up to a high of $77 a couple of weeks ago during the height of the Middle East conflict. But now that they've come back down, I mean, this kind of harkens to your point. The subdued oil prices are not doing a service to CapEx whatsoever. I mean, at least I would presume. how can oil maintain its price level where it is today? What's driving it? Why is it still kind of subdued despite us being in a fourth turning? We've got multiple theaters of war ongoing, and yet oil still, somewhere in the mid 60s.
I'd say it's probably due to sort of short-term downturns in China for the main culprit there. But no one really pays any attention to where it's likely to be a couple of years from now, or let alone 5 years from now. And that's where we try and position ourselves, or that's where our thinking is.
And Chris, what do you make of like this these subdued energy prices, even commodity prices as a whole? Like if you look at multiple commodity indices, we've been kind of seeing some slowdown the last 3 years or so. Why is that?
A lot of it has been as a consequence of, well, in the previous bull market, we had a buildup of supply, and that gets worked through. If you think about most commodity markets, what you do, like an obvious one is in the farming space, right? So if you're in any sort of northern hemisphere or even in the deep southern hemisphere, you have a very seasonal pattern. And so when winter comes, you need to have stocked up for winter, right? Now, commodity markets work in the same, especially metals markets, work in the same fashion, but they don't work on a seasonal basis to the same degree. It's much more multi-year, 7 to 15-year cycles. And what you find is that for example, where you suddenly don't have supply of something, and it's a shock to the system, what you'll then do is go, oh my gosh, I'm never doing that again. I can't have that take place, right? That shortage. And so going forward for the next 5-10 years, you'll say, we're always got to make sure we have adequate supply. We've got to have strategic reserves. We've got to have supply buttoned down. But then, of course, what happens is human beings are forgetful and lazy. And so over time you go, oh, we don't really need that much supply. We could use some up and da-da-da-da-da. This is how we get to the point where we're at today, where essentially there isn't the same degree of shall we say, backstop or supply in most of these markets. And yet at the same time, there isn't a desire to go out and secure it. Why? Because things have been so good for so long. It's fine. It'll work itself out. Wouldn't worry about it. She'll be fine, mate. It's all good. There's a lot of that steps into the markets, which is also why you have such cyclicality to it. And I'll give you a quick, if you go back and you look at, say, the uranium market, that was true of the uranium market for like a decade more. And Brad and I were invested into that, thinking, you know what, this doesn't really make sense. And it still didn't make sense, and it still didn't make sense for three and a half years. And then all of a sudden, it woke up and got out of bed, took a shot of Viagra, and everything was up 4 or 5 times. Now, the time to invest in those things is well before, right? It's well before it gets up and gets out of bed. Is that Uranium?
That's Uranium. Yep. So I remember. I mean, I don't mean to toot your guys' horn, but you guys were calling for.
You could go back to
your uranium call back in 2016. So
yeah,
even beyond the scope of this chart.
Are you on trading view there? Yeah.
So we were early on that. We started buying in, I think it was September 2016. We could see a whole bunch of uranium miners bottoming out, and it was unloved, unwanted. And at that time, we were the only ones who were really bullish on uranium.
Yeah, so it was somewhere around here.
There you go, 2018, 19. That's when we started. Yep. Okay, and then of course it got smashed. Look at that, dropped down. 2020 took a beating in the COVID fiasco.
Mm-hmm.
But look, the fundamentals hadn't changed, right? But it takes a while for the supply to be depleted and then for the market to wake up. Now, uranium, of course, it's a volatile space. Like, they don't all have the same not all commodity markets have the same dynamics. Copper's a bit different, and zinc's different, and platinum's different, and so on and so forth. But they all exhibit very similar patterns because they are all capital-intensive businesses. They're also simultaneously cyclical businesses that where the bringing on additional supply takes a long time. It takes a lot of capital and expenditure, and it also takes human resources, human capital. That's another one. So there's a dearth of human capital. You think about how many university students are running out now and getting a mining degree, right?
It's a rhetorical
That's
question.
been the case for decades, which is what sets you up for the very thing that will, at some point, bring a whole lot of people into the space, both human capital as well as financial capital. So back to answer your question as best as I can, it's a belief that the status quo will continue despite watching and seeing evidence that your supply side is being constrained. Like we were just talking before we jumped on and hit record about platinum. Platinum falls into that space. And so there's a supply-demand imbalance in platinum. And that has been true for some years now. It seems to now be moving, which is great. And we're profiting accordingly. But you could, why is it moving now? And why didn't it move 6, 8, 12 months ago? I don't know, Danny. I really don't know. Because I can tell you 6 to 8 to 12 months ago, the supply-demand dynamic was in our favor.
Mm-hmm. But it's you're betting on inevitabilities.
I like to make bets that are whens, not ifs. Mm-hmm. To quote Rick Rule, you make a bet on when something's going to take place, not if it's going to take place.
Now, when it comes to platinum, are there any platinum mining stocks out there? How does one play platinum in this case, other than the physical?
So that's sort of crux. There's only about 3. Sabanway, Stillwater. Now, the old Amplats, what's it called now? Volatility. And you can do an ADR through Impala Platinum in the US. So yeah, it's a bit tricky, and of course the problem is you're taking on a lot of South African risk with investing in these. That's a bit of a classic example.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you. And isn't the thesis on platinum predicated on the fact that these South African platinum miners will come across some sort of platinum shortfall? And so you've got like this inverse correlation between the two. So if the miners go down, the platinum price should go up because the supply side is heavily consolidated within these 3 companies, and then vice versa, right?
Yeah, look, with platinum, there's perhaps 3 things going on. First of all, you have the demand for platinum and palladium for catalytic converters. So there's been obviously a big push towards electric vehicles, and no longer the perceived need, at least, for platinum and palladium to go into catalytic converters. Now, what it's used for is it's used to draw out the impurities of the exhaust of diesel engines and also petrol. That's why, engines these days, particularly diesel engines, that run a lot cleaner than they did before. It's just because they've got a lot of platinum in them to with the converters, catalytic converters. You can go and look it up on YouTube or whatever, and how it all works. So there was this massive perception that electric vehicles will take over the world, and there's going to be no need for catalytic converters. Now, what's been happening in the last wee while is that electric vehicle sales are not living up to expectations. They're falling. If you actually go and look at electric vehicle sales and look at pure electric vehicle sales, they've been, I wouldn't say collapsing, but deteriorating quite quickly. It's only because that you've got sort of hybrids or plug-in EVs that are sort of keeping the stats up, but the pure electric vehicles like Teslas, etc., aren't doing very well at all. And that's also starting to come through in China. So now we're starting to see things like companies like Mercedes going back into producing, you can classic 6-cylinder, 8-cylinder cars. They're sort of moving away from the whole electric vehicle thing. For the life of me, I just shook my head. I could not understand how these German companies, be it VW, be it Mercedes, BMW, took this whole electric vehicle thing hook, line, and sinker. It wasn't just them. Of course, a lot of Americans as well. It's like, this is ridiculous. It's just not going to work. Anyway, so there's that. Now, there's something else. I was led to believe that platinum was actually a precious metal and is used as a store of wealth, and it was. It's less rare than gold. Like, you could have fooled me, because there's a massive discount to platinum versus gold. I mean, I recall back in 20 odd years ago, there's like there or thereabouts, there's like $1,000 premium of platinum versus gold.
Oh, really?
Anyway, so what I think's also in platinum's favor is its store of wealth, its precious metal status. And now the third bullish factor is supply. There's been no increase in supply, no capex in South Africa at all. In fact, if anything, that's been reality. There's mines have been closed down, put in care and maintenance. And now they'll take a long time to come back out of care and maintenance. So supply is going to be very, very restricted. It'll be a few years before any significant supply can come online, even more than that. There's something, this is anecdotal. Go to a gold depository and ask them, okay, I want to put $500,000, I want to invest $500,000 into platinum. And they'll go, oh, okay, yeah, it might take us a few weeks or a month or so to get that for you. The point being is this not there. The supply is not there. Not even, the depositories can get hold of supply of good old-fashioned platinum bullion. So this is why we're probably seeing a price doing what it's doing. And it also highlights to us, this was obvious a wee while ago. So we bought Stillwater Sabanwe. I think it was last year sometime, Chris. I must be getting old. I'm sort of losing track of time. But yeah, it was last year sometime. Now, Stillwater Sabanwe actually at one point was down close on 40% from where we bought it. Even the sort of price of platinum had gone sideways. And now, of course, it's taken off. It's up a few 100%. And that sort of signifies or demonstrates the difficulty investing in these commodities is you can be wrong for a long period of time. And all of a sudden, bang, overnight, virtually within a month or so, you're a world's greatest hero. It's, I think, the hardest game in investing commodities is having the patience, because it does take a long time for the stuff to play out. So
here it is. Sometime around last year. This is a 1-year view of things. It's really started to kick up back in late February, early March of this year, and it's It's been
It's probably
higher.
about $1,800 when this is a South African price, but it was probably the 1,800 Rand level.
Mm-hmm.
Well, it's actually, 800 Rand level that we bought into Sabanwe, and you can see there at one stage it was down at 1,400. Charming. Yep. So of course everyone's looking at us sideways, and now it's doing good things. But anyway,
I'm just looking at the Finviz thing. I mean, if you go back to the previous highs in this, which was 22.
Yep.
What's it?
70,
March
7,500. Yep.
With that would be a 3x return from here, just for us to get back to that. So despite the fact it's kind of bumped up a bunch, if you look at a long-term chart, it's like it hasn't actually moved that much.
Yeah.
Well, if you consider where gold is and how platinum usually trades at a premium to gold, I suspect when folks finally start to realize the precious metal qualities of platinum again, it'll really race.
Yeah, here's platinum divided by gold. So platinum relative to gold, and let's go ahead and pull this chart out as far as possible. So this is on the log scale, by the way. So we've got a ratio of about 41. So 41 to 100 when you're looking at the platinum to gold price. And at one point back in the 60s late 60s, you were at a 5 to 1 when it came to platinum to gold. So we are severely in depressed territories when it comes to platinum priced in gold.
There we go. And we looked at that last year, and I was like, okay, this is crazy. But it also it's a leap of faith because we invested in the miners and sort of making losses at that stage. So you got to sort of try and project, okay, what's likely to happen? What are the earnings likely to be, say, 5 years out? What's platinum likely to do? And on that basis, these things are incredibly cheap.
Yep. Before we dive into any more of these charts here, guys, I want to do a quick plug for your newsletter here. I recommend it all the time. It's the newsletter that got me interested in commodity investing. And you guys are really my first exposure into this space, whether it be gold mining, silver mining, uranium mining, copper mining companies, energy companies, etc. You guys are always on the ball when it comes to finding some very unique investing themes and propositions. Platinum being one of them that you found about a year ago, and now it's starting to play out. So, there's some really good outside of the box thinking that you guys do, and I want to encourage my audience to, at least consider joining Capitalist Exploits. It's you do get a special $1,000 off by clicking on the link down in the description box below for a special offer for CapitalCosm viewers. And looking at some of the stats, you guys have managed to outperform the S&P and NASDAQ since 2020. You get a whole host of features, stock picks, over 100 investments you can buy, spread across many industries. You also get a dividend portfolio that you recommend as well. So in addition to your capital gains portfolio, you also get that dividends portfolio. Why should investors, check out Capitalist Exploits? Who is this for and who is this not for? Chris?
I'd say it's for people that are looking to protect their wealth and that have a long-term vision and time frame, which I incidentally think is the greatest advantage that any individual actually has over and above, the large funds and fund managers out there, because they're all required to report quarterly returns. They're all always afraid of redemptions and things of that nature. You as an individual investor don't have to worry about that. You can take a longer term view and you can position yourself accordingly. And the strategy, as we've proved, works over time. But it does involve allowing yourself to actually have drawdowns in often not across the portfolio, but just in individual sectors, as we've just shown you, right? So the drawdown that you had in, say, platinum, if that's going to get you wiped out, where you think, oh shit, I'm out of this is not working for me, well, then your psychological makeup is probably not particularly well suited for our services. But essentially, it's for anybody. There isn't, we're not speculating on wild, crazy things. This is where we have the vast majority of our own capital. I see it as being highly risk averse, actually, despite the fact that we use the terminology asymmetry, which is, often people look at that and go, oh, you're looking for big returns. Well, yes, but in large part, we're looking to not lose money too. And which is why you buy deep value, cheap assets. So I'd say it's for anyone.
Excellent.
We bring something different, very, very different to the table than what most other newsletter writers write about. So most of our investments, we look for opportunities globally. And it's not just in commodities. It just happens that at this stage, commodities is where the great value is. But we look globally for opportunities. And we're generally looking for, a lot of these things are like sort of small cap stocks. And those are sort of opportunities, ideas that no one else really brings to the table. A lot of our positions are in sort of smaller, lesser known markets. As I said, it's not just commodities. We have a dividend portfolio which looks at high-paying dividend stocks globally. There was this one famous example we used a couple of years ago. We invested in it. It was an Israeli cigarette distributor paying a 25% dividend yield on a PE of 4. And I thought, this is crazy. This is just a once-off. And you go and look at the financials, like, no, it's real. And to this day, we still own it. Still got a dividend yield of 12% now, I think it is. Anyway, those are just some of the examples. At the moment, also popping up, looking quite interesting, of sort of oil service stocks coming out of China. Again, you can hear a pin drop that no one else talks about this sort of stuff. So I think that's what we bring to the table, something very, very different that what everyone else has been exposed to. And certainly, we have no interest in talking about NVIDIA or Microsoft or Amazon and so on and so forth.
Yeah, I'm not going to, poke and prod you guys to give away more of the special sauce, but the value is definitely there. I encourage you guys to check it out. Link is down below. Get a special $1,000 discount when signing up with the special link. All right, guys, let's get back into the charts here. We mentioned gold. Gold is at 3,300. It looks like it's having a bit of a consolidation period here. I've talked to my audience a number of times about this chart. So this is the gold price chart. You can see kind of here circled over time is you do have these consolidation periods that do play out, that have played out over the last 18 months or so when it comes to gold. And they typically last around 4 months. And what's interesting to this time around is that we kind of started this period here at around April, which is very similar to when we started the one last year in April as well. And it lasts all the way out until August. So I want to get your thoughts on the gold price. Is the asymmetry still there in gold? Do you still see any pristine opportunity in gold?
Well, we're in a debt crisis, so the answer is yes. Despite that, I would say the divergence now appears to be in the gold equities relative to gold. That's what is somewhat more interesting to us, which is not to say we're bearish on gold. I think it's gone up a lot, almost in a straight line, which leads me to be of the opinion it's likely to probably pull back at some point, yeah. But, it could pull back to, I don't know, 2,700 or something and still be in a raging bull market. So I think it's something that you should own. But like I said, the gold miners are now the cheapest they've been for decades on a free cash flow basis. And they're very profitable and they're basically under-owned. So that's where our attention is drawn to. We go where there's value, Danny. It's not like we have some predetermined idea where we love one thing over another. You call us in, I don't know, 10 years, and we might hate gold. You know, it's just
Right.
or oil or any number of these things. It's dangerous to be tied to these things. They're not your wife or your husband. They're just equities.
Yeah, and that's one of the lessons I remember from you guys very early on when I became a member, and it's that don't get married to these stocks, because eventually there's going to have to come a time where you get divorced, i.e., sell the stocks. So,
Yes.
Mm-hmm.
Go ahead, Brad.
Well, you know, if our suspicions are correct here, when we're entering a sort of a debt crisis, it's a sort of debt crisis / monetary crisis. It's not going to be very, very difficult for gold to double from current values. That's only like a doubling. But imagine if the gold price doubles, the asymmetry offered in the gold miners, because they become incredibly profitable for every, $10 or $50, whatever that the price of gold goes up. It translates to their bottom line in an asymmetric fashion.
Right.
So we're likely to find that gold miners play catch up big time to the gold price. In fact, the gold price is going to go way, way higher. But yeah, I guess you could, and perhaps, Danny, this is where things start becoming a little bit tricky. When we first invest in these things, often no one wants to touch them with a 40-foot barge pole. And they've usually been out of favor for such a long, long period of time. And you know damn well that when they come back in favor, the upside will surprise everyone, probably including us, in terms of duration and magnitude. And there's two greatest risks we run. A, getting in too early, which usually happens. I guess the risk there is you run out of patience. But following on from that, when these things start to run, is getting out too early. Because, as I said, usually these things have been in a bear market, unloved, unwanted for a long, long period of time. And it doesn't hurt to run with the crowd for a bit. Now, that being said, I don't see anyone jumping up and down for gold miners. In fact, you go and look at the gold mining ETFs like GDX and what have you, the amount of shares in issue have been decreasing. They haven't been increasing.
Right. And then you look at GDX relative to gold, which is what we're looking at here. This thing is at pretty much an all-time low. I mean, it bounced off an all-time low back earlier in the year, but it's still at very depressed levels. And then, again, this is looking at it logarithmically. If you look at it from a nominal scale, then, I mean, there it is. I mean, it's still, it hasn't even gotten off the mat yet.
And there's the asymmetry. Yep.
And so for people who can't
just get back to 2011 levels, there, Danny, is that's
it's a doubling. So that's a doubling in the ratio between GDX and gold, and that's assuming that gold stays constant, right? Which will probably not be the case if gold continues to move on higher. It becomes an added multiple to the asymmetry to the for the GDX ETF. So very interesting. I also want to belabor another point here. You guys also alluded to the fact that some of these mining companies, when the asset begins to move, they begin to experience gains, not nominally, not linearly, but asymmetrically. Because again, let's pretend you have a gold price of $3,000, and you have a company called Company X, and companies making it costs them about $2,900 to mine this stuff, and so they have about $100 margin. Now, if gold were to move from 3,000 to 3,100, albeit a small percentage on the physical scale from 3,000 to 3,100, you realize that their profit margin actually doubled as a result. Now, I'm not saying that's going to happen with every gold mining company, but that's essentially the idea, is that their margins they become accelerants to the gold price.
And a lot of their cost base will be essentially fixed. Yeah.
Mhm. Right.
That's why you get the asymmetry when the gold price goes up.
So, guys, I want to get your thoughts here. I think we've covered some of the key points here as it relates to the commodity market, but some recent developments domestically here in the United States when it comes to the Fed and all. I know you guys are much more long-term vision, but you had this letter penned by President Trump, where he said that Powell is again late to the party and he's going to find someone to replace Jerome Powell, the Fed chair, and interest rates need to be lowered to sub 1% or something like that. Now, if a move like that were to be done, what would happen to the commodity markets? I mean, I could already tell what would happen to the stock market if interest rates were all of a sudden just dumped down to a Fed fund rate of 1%. But what does this portend if President Trump does follow through with what he's threatening?
Well, the issue is that A, he can't, not under the Constitution. The president doesn't dictate monetary policy. So it's like much of what Trump does. It's bluster and bullshit. But secondly, if you lower the cost of capital, what you're doing is you're lowering the attractiveness of the bonds, right? The reason that bond yields are rising is because people are determining the bond to be of higher risk, and so they're looking for a greater compensation, okay? And of course, the bullshit around the fact that there's no inflation or there's deflation is now evident to even anybody with half a brain cell. Why? Because they look around and they see what did a coffee cost them last year and the year before, and their electricity bill and their gas bill and their and they all realize, holy shit, inflation's running at a whole lot more than what they're telling me. And so as a consequence, to protect your capital, you need to have a higher rate of return. And that's true whether you're just a domestic Joe Bloggs trying to run your business, or if you're an international overseas investor. So this is why bond yields are rising, and it's not just in the United States. So manipulating and going in and pushing down that cost of capital means that the demand for the bonds goes away, right? At the end of the day, you can't dictate the price that you sell an item for, right? Not without paying the consequence, right? So, for example, we have a publishing business, right? And so there's a price that that subscribers pay for it. If we decided tomorrow that the price of that, we want it to be a different price, we want it to be $10,000, right? We can do that, but we can't do it without the consequence. And the consequence will be that lots of people will be like, well, I don't think I'm going to pay $10,000. I don't have $10,000, et cetera, et cetera. So you're always having to meet the market. So this is the same thing. And it's the problem with centralized planning. You know, centralized planners come along and they think that they can dictate what the market price for some item should be. It's always been a failure. It always will be a failure. And now we're just watching the same nonsense transpire. But like I said, despite the fact that he can put some pressure on, but he doesn't have the ability to actually go and, to my knowledge, to go and actually set interest rates for the country.
Right. Well, I think that I just had the 10-year shown on screen. We'll pull it back up here again. And this is what you were alluding to, Chris. We've been in a rip on higher when it comes to the 10-year yield since sometime around 2020. I mean, this thing has been moving on higher. It has been moving sideways recently. Do you anticipate further movement to the upside when it comes to the 10-year, these bond yields as trust begins to erode?
Look, I mean, you can cap inflation. You can cap your bond rates, but then you just get a let inflation rip.
Mm-hmm.
You can do it theoretically, sure. But again, not without the consequences. And what's interesting, and we saw this in particular in 2022, was that as the market sold off, S&P was down 20-odd%, 25, I think. And ordinarily, one would have expected bond yields to fall, bond prices to rise, right? That's the whole point behind a risk parity trade, which is your 60-40 bond equity split, right? And that was meant to protect you in an equity downturn. Guess what? It didn't work in 2022.
Nope.
And we don't think it's going to continue to work. We're watching now as equity markets get weak, bonds get weak too. So investors that are invested into the traditional 60-40 bond split, they've gone down the road to Fidelity or Vanguard or whoever it is that's selling this stuff. And they've always put them into the same structured products, which is some variation of a 60-40 bond split. And the problem that they're having now is where the equity markets do not perform for them, they're not getting compensated on the bond side of things, which means they double whacked. And then if you go and you look at the component of investment capital into various markets, you can see, and I highlighted this, remember this, Brad, when we were in Cayman Islands a few weeks ago.
Yeah.
Capital invested into emerging markets is sub 1%. Capital invested into gold and or precious metals is about 2%. And into commodity markets is under 1%. So these are the sectors, the asset classes, which don't have any of this capital. And guess what? If you go and you look over the course of even just from say 2021, as the chart you're looking at there, we have outperformed. This is a structure. I believe it's a structural change. It'll take time, and at some point, all of the champion chimpanzees on CNBC will be talking about this. But we're a long ways off that, I think.
And President Trump kind of gave it away. Elon also gave it away too, when they pretty much conceded that cost cutting will probably not work. That they have no choice but to go full broke and go all in on growth to try to escape the debt spiral here. Yeah, go ahead.
The cost cuttings has been smoke and mirrors. For anybody who can do math, that's clear, right? So Doge came out and they saved about 40 billion. You got a 37 trillion deficit.
Right.
What are we even talking about? This is ridiculous. It's retarded. It's smoke and mirrors. It gets all of the voting masses hooting and panting and going, yay, yay, we're doing this, we're doing. No, it's meaningless. It's completely meaningless. It's theater.
$3 million.
I'm all for cutting USAID and a bunch of other, funding transvestites in Peru and whatever the hell they were doing with this shit. But that's not the point. This nothing stops this train.
Yep.
As Lynn Alden likes to say.
Very true.
Nothing stops it until inflation stops it for them. The other thing which is bizarre here, Danny, is I don't think anyone believes it. If you were to believe, well, except maybe a few gold investors, if you were to believe that inflation is going to run rampant and rates are going to go way higher, you certainly wouldn't be paying high PEs for these growth companies that we're currently seeing.
Yep.
And yet they still are. If people were believing in inflation, you're seeing gold miners really take off relative to the price of gold, in fact, relative to everything actually, and so on and so forth. We're not really seeing it. We're not seeing much in the way of money going into gold miners, gold, in fact. So yeah, it's almost like the market is living in denial of the ultimate outcome here.
But how can the market be in denial? I mean, isn't the market supposed to be the wisdom of the crowd? How's that work?
Yeah, well, yes, but I mean, if you're positioning for where things are likely to be 5 years out, it's the market's always inefficient.
Understood. Well, guys, I think we covered a whole host of different topics. I think we've covered pretty much everything there was to talk about. That's topical. So thanks again for coming, guys. I really appreciate it. Anything else that you want to, talk about before we wrap up here? Chris, Brad.
Well, I think Chris alluded to it. The greatest asset we have as individual investors is being patient. We can have a longer term time frame than institutional investors, and We shouldn't forget that. And that's our secret weapon. I can't understate that enough.
That is an edge in and of itself. Patience.
Correct.
I think if you just, if you keep things simple, you buy what's cheap, you stay away from the shiny objects. That is the core to successful investing. There's a number of investors that have repeatedly mentioned in our writings and that, all of which who've managed money for decades, and they all do the same thing. There's Anthony Bolton, there's Howard Marks, there's what's his name, Brad? Good old
Walter Schultz. The list goes on, and
they all fundamentally do the same thing. They've not concerned themselves with the noise, if you will, of the day. They buy when things are cheap, and they stay away from things that are expensive. It sounds really, really simple. It's simple, but it's not easy. People find it not easy because we are emotional creatures, so we get caught up in news flow and all sorts of other things. Like I said, if you understand the situation that you're in from a historical perspective, then those things can be put into context such that you don't get emotional about them. You go, oh, yeah, I was expecting that. That's sort of to be expected. It sucks, but here it is. Am I positioned accordingly for it? Yes, I am. No, I'm not. You'd make your decisions, and that's it. And you don't get too caught up in the rest of it.
Yeah, it's as if anticipation is a key factor for investing. So, guys, thanks again for coming on. I really appreciate it. If you'd like to become a member of Capitalist Exploits, we do have a special $1,000 off. Again, that is in the description box down below for those interested. Highly recommend it. I encourage all you guys to at least consider it. So if you enjoyed this podcast, drop us a like and comment, go Chris and go Brad. If you disagree with anything, let me know what you disagreed on. I do, in fact, read the comments. So with all that said, thank you guys for watching, and I will catch you next time. Bye, y'all.
Thanks, Denny. It's always a pleasure.